have Mr. Mike Frick here?
Yes.
Yes, wonderful. Nancy Marsh?
Present.
All right, Chad Rainey, not able to join us yet. And we have one resignation and working to fill that position. We appreciate the great service of Diane Kinsworthy Bly. All right, and we will now have the reading of the live streaming disclaimer.
Great.
Susan, thank you.
Capital Cities LLC is an investment advisor registered under the Investment Advisors Act of 1940. The content of this presentation is provided for information purposes only and is not to be relied or acted upon as a recommendation or investment, legal, or tax advice of any kind to any viewer through electronic media. This presentation also may contain forward-looking statements which are based on the beliefs of the information available to Capital Cities management. Actual results could differ materially from those expressed in or implied by these forward-looking statements. Past performance is not a guarantee of future results. Capital Cities does not control the website or domain on which this presentation is stored and disclaims any responsibilities for any information, services, or products found on websites linked to the page on which this presentation is stored. The unauthorized use of the content of this presentation without the express written consent of Capital Cities is strictly prohibited.
Thank you. We have reviewed the November 14th, 2024 meeting minutes. Is there a motion to approve those minutes?
I'll move to approve as submitted.
All right, do we have a second?
I'll second it.
Thank you. All in favor, say aye.
Aye.
Any opposed? So moved. We now have the third-party administrators report. I'd like to introduce Michael Burkhart and John Archer.
Good morning. I'll go first this morning. My name is John Archer. I lead our retention and growth efforts across the central part of this great country. We had an opportunity towards the end of 2024 to relook at our talent leading the Hoosier Start Plan, and I'm excited today to formally introduce Kim Rumpel as your new leader. I think I was supposed to say illustrious Kim Rumpel.
Yeah, welcome.
All kidding aside for Kim, I think this is almost a homecoming for Kim as she's been part of this plan for so long, even longer than Nationwide has been a steward of the record keeping. And she's built incredible trust and partnerships over the years. And so we're just grateful, Kim, for you, number one, but for our partnership with the Comptroller's Office and your staff have been incredible through the transition. So we're excited to start a new page in 25 and move forward together.
Thank you very much. It's a pleasure to be here. I'm grateful to be in the position and I'm very much looking forward to continuing the work that I started a long time ago and hope to continue for a long time. So thank you very much.
Thank you. We really appreciate you being on board in this added capacity.
And I'm looking forward to working with her as well. So thankfully we've developed a pretty good rapport over the last couple of years. So I think that's going to be a very strong partnership going forward. With regard to the participant education and service, Kim is still getting her arms around everything. So I think we'll regroup and report more robustly next quarter on those efforts. Needless to say, we did meet our participant goals and our workshop goals and the site visit goal for 2024. So we're happy to report that. We also have some efforts coming with regard to education around the My Interactive. I keep calling it the wrong name, My Income and Retirement Planner, because we changed the name. We changed the I from interactive to income. The main financial planning tool that we make available to participants, and we have education that's going on currently for that to just kind of make sure participants understand the tool. Some nice web content that's out there. We've been working very closely with Emily and Stacy to get that information out to your participants so they know it's available. And then we do have some financial awareness month, some marketing efforts around that in April. And so that's coming, and then as well as a custom campaign around participant retention in the plan, getting participants to understand the value that they have within the Hoosier Start program before they make that decision to move out into a more of a retail solution they may be paying more for. So those are things that are on the horizon here.
May I ask a question? When you say financial awareness,
Mhm.
what is that?
So it's a little broader than just deferred comp. It's really, more about saving in general, financial wellness, things
Mhm.
along those lines. Excited
Thank you.
to bring that to your participant base. So, and then as always, we work in partnership with your staff on that. I'll turn to the book to talk a little bit about the quarterly reporting. I don't want to take up too much time because I know we have a pretty robust agenda with capital cities. I did want to share something on the like first page after the title page. Our ranking that just came out from JD Power. You may be familiar with JD Power. They do a lot of rankings, more around cars. It's at least traditionally I've seen that. But recently they've really kind of moved into financial services and lots of other different sectors of the marketplace. But they do what's called the Retirement Plan Digital Experience Survey. And we fared quite well in that, ranked number 2, only second to Charles Schwab, and well above the average score for the various firms that were reviewed. We beat the average overall by 36 points and increased our own score by 55 points from 2023. So pretty proud of that. And in terms of looking at the 4 areas that they looked at, the various factors, we scored above the industry average in all 4 of those significantly. So we're happy that the experience that we provide your participants is being acknowledged within the ethos, and we're not stopping. We're not resting on our laurels. We have some. Obviously, this was done before the My Income and Retirement Planner update, and so that's a huge step forward. And then we have, in fact, I think it may be live now, or is coming early next week, a pre-login refresh for the website that makes it way easier for participants to find information out on our website. So a couple of exciting updates there. So hopefully we fare even better next year in each study. So turning to the next page on this report, it's largely a flat quarter in terms of gains within the plan. Overall plan assets are down just a little bit from 2.151 billion to 2.136 billion. You turn to the next page. We did have participants with a balance increase significantly in the upper right-hand corner, almost 1,200 additional participants in the plan with a balance. New enrollments, we had 4,200 during the quarter, which is a significant increase from where we were in the third quarter, 850 more from quarter to quarter. Rollovers out do continue to be something that we keep an eye on. And our efforts that I mentioned regarding participant retention are targeted to kind of help with that number. On the next page, looking at average account balance for participants on the second one down from the left, the average participant balance overall is 30,713. That is down just a little bit. Both the market activity of the quarter and then adding all of those additional participants really made a difference and moved that average balance down a little bit, but not a huge difference. Median participant balance also down a little bit. Median is right around 5,700, which isn't a surprise with auto enroll and everybody coming in at basically $15 per pay. Average number of investments, I did want to call that out. It went from 3.17 at the end of last quarter to 2.81 this quarter, and that's, I believe, because of the consolidation of a couple of investment options that we had. And then Roth usage, if you kind of move to the right-hand side, 8,250. And on the next page, we'll look at, the next page, we'll look at how much that increased, but significant Roth usage. In fact, 360 more participants, if you turn to page 5, have Roth balances than did it at the end of September. So that continues to be popular, and I'm blown away every quarter by the fact that this number just continues to increase quarter over quarter. Our self-directed brokerage account, we had 2 more participants join in the fourth quarter, so we have a total of 9. So and $2.2 million so far in that solution. So not surprised that it's a little slow to take off. It's it's only intended for those who have more of an advanced knowledge about investment options. So for most people, the core investment options you offer are sufficient. Looking at contributions on the next page, this is one of those rare quarters where both the third quarter and the fourth quarter had 7 pay periods at the state contributions that we posted. So not much difference there. We're down just a tad, and that's usually due to the fact that participants, there's a certain subset of participants who max out towards the end of the year, and that number kind of tends to go down just a little bit at the end of the year, and then pops back up at the beginning of the year when they start the new year. Then looking at in the lower right side of page 6, where your current salary contributions are going, just kind of point out that almost half of new money coming into the plan from participants is going into your target date funds, because that is your default, and this is where that number is going to continue to increase over time. Looking at distributions, I will point out a couple of things on this. I already pointed out the rollover numbers, which actually were down just a little bit from third quarter, but required minimum distributions, that number always pops up in the fourth quarter because we process participant required minimum distributions. The defaults happen usually in November. So that number will go back down, and then we're keeping an eye on the unforeseeable emergency distributions. Pretty much flat there, just 2 less in the fourth quarter compared to the third quarter. So hopefully that has kind of evened off or leveled off, and doesn't continue increasing, because we've seen significant increases since we made the change to certification on unforeseeable emergencies. I will skip the rest of this. I did want to go to the last few pages within this, right before the tab that says State of Indiana. We have a page 31. And this is an annual view rather than just a quarterly view. So page 31 gives you the kind of a better view of what happened during the year. And even though we were down a little bit in terms of gain loss in the fourth quarter, over the course of the year, we had $218 million in gains, along with the $28 million in capital gains, dividends, interest, etc. So significantly good year in 2024 in terms of earnings on the plan's assets. Distributions pretty much offset contributions there almost exactly. So, and then if you look at page 32, assets over participants, the plan balance increased by 13%. That's the percentage change year over year, and the average participant balance increased over the course of the year by 8%. And you had 5% more participants at the end of the year than you had at the beginning of the year. And then on page 33, and this is where I'll end and ask for any questions. Just kind of overview of distribution. The top is participant requests for payouts. directly to the participant, and then the external pay uses the section that handles the outgoing rollovers and transfers. And which gives you an idea of where most of that money is going, with a significant portion, which we've seen all along going Edward Jones, Charles Schwab, brokerage firms. Participants are electing to take their funds to have them managed. So with that, I'll ask if there are any questions. Lots of good detail in here. And if you don't have any questions now, after you've had a chance to take a peek at it, I'm happy to answer any questions.
No questions? Okay. Okay.
All right.
Thank you for this report.
Thank you.
Really appreciate it. Next, we will have our investment consultant, Capital Cities, provide us with a report.
Great, thank you. I'm going to turn it over to Susan. We're going to start with an annual market review. Excuse me, presentation.
We'll begin on page 2, which highlights our agenda for today. So we'll take a look at key market indicators, market returns, potential themes that could continue in 2025, how we design a plan to meet those uncertain market environments, and we'll wrap up with our fiduciary calendar. So taking a look at page 3, when we think of the health of the US economy, we think of 3 main indicators: real GDP, inflation, and unemployment. All 3 generally ended positively in 2024. So if we take a look at the chart on the right, this represents GDP and unemployment. At the end of 2024, unemployment was below the 20-year average, which is represented by your orange solid and orange dashed line. And sorry,
I
we're
need to
the
get our
first step.
page.
Yeah,
Oh,
there you
thank
go. Yep,
Yep.
sorry.
Thank you.
And then real GDP is growing year over year, and it's higher than the 20-year average, and those are represented by the blue solid and dashed line. And then looking at inflation on the bottom left, the green line represents inflation and the purple line represents the Fed funds rate. And as we can see, with the rise in the Fed funds rate, inflation has lowered, and the Fed has nearly achieved their goal of 2%. However, inflation's remained a little sticky, ending 2024 at 2.9%. So what did this mean for market returns? If we look at page 4, this page details returns on a quarterly basis. Investments are mixed quarter by quarter. One consistent area that you'll see are those blue bars, which represents US equity, and that's the only broad asset class that finished positively in every quarter. Looking at the third quarter, all asset classes finished positively as the Fed began to lower the rates in September. We did see a reversal in the fourth quarter with the uncertainty around the election and what the new administration's policies would be. And then turning to page 5, we'll take a look at calendar year returns here. If we concentrate first on the gray column in the middle, in 2024, we saw strong returns over every asset class except for non-US fixed income. And then looking towards the left for the calendar year returns, we saw solid returns over the last 5 years, except for 2022. We also saw the broad US stock market generate over 20% in each of those calendar year returns, except for 2022 again. And then looking at 15-year returns, broad US equity and large cap US equity have been the strongest areas and outpaced small cap. Broad fixed income did generate a 2.4% return over the past 15 years. And then turning to themes that could continue into 2024. On page 6, the Fed did cut rates by 1% in 2024, and they forecasted 2 25 basis point rate cuts in 2025, which is represented by that green line in the top chart. However, markets are now pricing in 1 rate cut and expecting that later in the year. And then looking at the chart on the bottom, we've talked about the yield curve the past couple of years. We did see a normalization in the yield curve in 2024. This is the first time since 2021 that longer term yields were higher than shorter term yields. And a normalized yields curve generally reflects a healthy bond market and positive economic growth, which has some economists forecasting that we're going to hit that soft landing in 2025. So moving to page 7, we'll take a look at some asset class themes. This page highlights fixed income and the recent rate volatility. So we'll start on the chart on the right. And the short story in this chart is that little green bubble there. And it shows that over the last 3 years, volatility has spiked dramatically. And that's not surprising given the recent rate movements. And then looking at the chart on the left on the bottom, this chart's comparing that same 3-year time period. The gray area represents excess returns, and then your black line is the median or the benchmark of active fixed income or the median of the broad market. The orange line represents active fixed income managers, and you can see that they're outpacing that median or broad market index. Assuming that that rate volatility continues, active fixed income management could continue to add value. And then turning to equity markets, we've seen 2 main themes in equity markets, and that's the continued concentration in the S&P 500 and then high valuations. So looking at the chart on the left, you can see in 2024 that the top 5 stocks in the S&P 500 represented over 27% of that index, and that hasn't happened since 1964. Those 5 stocks are all connected to the AI movement, and they all had an inflow of cash in 2024. And then looking at the chart on the right, this is a snapshot of stock market valuations. Valuations are really high, and that's driven by that AI boom. They're nearly double the 30-year average. And we only mention this because high value markets can experience sell-offs when you have changes in fundamentals, policies, or sentiment. And then looking at page 9, we've listed on the left-hand side all of those ongoing themes that we just talked about. So what does this mean for the plan? We've developed a diversified investment menu. We have those target date options for those who want to do it for me portfolio. We also offer the managed accounts and self-directed brokerage accounts. We have the IPS, or the investment policy statement, which defines that roadmap for the plan. It outlines our roles and responsibilities and the monitoring of our investments. And then we always follow our fiduciary calendar to ensure that we're exceeding those duties. So looking at page 10, we have our fiduciary calendar for this year. In the second quarter, we'll review the investment structure review. And then in the third quarter, we'll do a record keeper due diligence meeting and follow up in the fourth quarter with any special projects or relevant topics. And then lastly, turning to page 12, we did want to announce that we've added a new team member. Ryan Datillo joined our team. He's a recent graduate of the Kelley School of Business at IU. We're just really excited to have him, and we wanted to mention this because you may either see emails from him or may see him attending a meeting in the future. Are there any questions before we move to the report?
I don't have any.
Thank you. Well, behind tab 1, we have our fourth quarter performance and evaluation report. And I'll go to page 1, which is our considerations and observations. Susan discussed the annual market review. We also have our fee analysis, and we're going to go ahead and present that this quarter. And the reason being is the next item, our annual report. So we give an annual report to the State Board of Finance. It's this exact same report, excluding the considerations and observations, because these are for the fourth quarter. Instead, we have a memo that outlines the changes that happen throughout the calendar year. So I'll go through that, but our purpose here really is we'll go through the report, we'll go through the fee analysis, and then we'll ask for a vote to approve the report, because the back of the report does have that updated fee detail that we have within the fee analysis. We also have the investment policy statement. As you may recall, we passed that out at the last meeting to give you an opportunity to review that amendment. In particular, we are amending the responsibility section to include that only financial factors will be utilized when we design the investment menu or do that ongoing monitoring of the investment managers. So we'll go through that in a few minutes. We do have a couple updates regarding our investment managers with State Street, our target date funds. The retirement income fund will be renamed the retirement fund as of March 31st. And also the 2020 fund is rolling into that retirement fund. That process happens every 5 years. As those funds become more conservative each year, they roll the fund that's closest to retirement into retirement. And then we also introduce a new fund for our youngest participants, which will be the 2070 fund. The committee already approved those changes. The 2070 fund will be implemented in mid-April for participants. And then just one quick note, State Street did adjust their asset allocation within their underlying funds to make it more market neutral. So they increased their allocation to US large cap from 80% to 85% and reduced their allocation to US mid cap from 20 to 15%. So just wanted to note that slight adjustment in terms of their construction of their target date funds. And then moving ahead to page 2, we do want to talk about the State Street Investor Voting Choice Program. We have some updates there. If you don't mind, I'd like to put that with the investment policy statement because I think that flows really well together. So I'll put a pause on that one until we get to the investment policy discussion. And then Fidelity Low Price Stock, Salem Hart did transition off of the fund. He did quantitative analysis. The 2 lead portfolio managers, Morgan and Sam, continue to manage that fund. But as you know, we monitor personnel changes and wanted to note that personnel change. And then the investment menu changes did occur on November 8th that you previously approved. So that was eliminating Vanguard FTSE Social Index, mapping it to State Street 500 Index, eliminating American Fund Zero Pacific Growth and mapping it to Fidelity Diversified International. And then we decreased the expense of the Fidelity Diversified International by transitioning from the A to the C share class. All of that did occur on November 8th, and the changes are reflected in this report since it happened in the 4th quarter. I won't talk about the markets since Susan just did a great job of covering those. We can move ahead to page 7. And page 7 outlines our assets. We ended the year with roughly 2.1 billion in assets. Roughly 500 million of that, or 23%, were within our target date funds, or a default option if a participant doesn't make an investment election. Then we had 1.6 billion, or 76 or 77% within our individual portfolio options, those that allow participants to build their own diversified portfolio. And then finally, as Michael mentioned, we have 2.2 million, or 0.1% within our new self-directed brokerage. I did want to point out, the important role that State Street plays, just given we'll be discussing that investor voting choice program. Again, we have 500 million within those target date funds. We also have State Street within the S&P 500 index, the Russell Small Mid Cap Index, and also the U.S. Inflation Bond Index. So in total, roughly 921 million, or 43% of our assets, are with State Street. All within passive mandates. So meaning all of those mandates just simply seek to mimic a benchmark at a very low cost. So just wanted to note that for later in the discussion. On page 8, we highlight our stoplights. So how we monitor each of your investment options from both a qualitative and quantitative perspective per your investment policy statement guidelines. You can see the vast majority are green. We are continuing to monitor T. Rowe Price Blue Chip Growth Fund, its long-term performance or 5-year performance. That was a fund that we previously had on watch lists and removed from watch lists given their improved short-term performance, but we'll continue to monitor that 5-year number. And then Fidelity Diversified International, we're monitoring the 3-year number, which was really given its growth bias in 2022. Continue to feel favorably about that fund, but we monitor that 3-year number. And then in terms of performance and how, if you had a diversified portfolio or if you were in the State Street target date funds, within the 4th quarter, returns ranged from negative 1.7% with the Retirement Income Fund to negative 2.3% with the 2065 fund. However, as Michael mentioned, if you look at the full year in terms of performance, really strong returns. So 6.9% within the retirement income, all the way up to 12.8, the 2065 fund. So if you were invested for the entire year within a diversified portfolio or the target date funds, you should have had, a very positive return. So I'll pause there to see if there are any questions regarding the report before we flip into the fee analysis.
Good.
Okay, great. Well, behind tab 2 is our fee analysis, and as I mentioned, the details of this is included within the appendix of the report that we just covered. And we'll go to page 3, and page 3 just highlights the fees that we typically find within a defined contribution type plan. So we have our investment managers, and that generally represents the majority of the fees that are paid. That's, State Street, Fidelity for actually doing the day-to-day managing of those investment options. We also have Nationwide as our record keeper who handle the day-to-day operations of the plans. And then we even list our fees as a component and very transparent about that. So we'll go through all 3 as part of this presentation. And we'll start with the investment management fees on page 4. And within the investment management fees, you see our checklist, and you may recall these from previous years. But first and foremost, we want to make sure that our fees are transparent for participants, and they are. They're clearly provided online and on their fact sheets. We also make sure with investment management fees that we're in the most appropriate share class or vehicle for each investment option. New share classes and vehicles are coming out every single day. As part of our due diligence, we're emailing each investment manager and saying, hey, we're on the Nationwide platform. We have X dollars. Tell us that we're in the least expensive share class or vehicle available to these participants. So that process happens annually as part of our due diligence. Historically, the committee has always given participants the most favorable share class with all things being equal where we've been able to. One item that we're currently monitoring is the PIMCO Total Return Fund. There might be potential to reduce that fund's expense. We're getting close to the minimum for a less expensive vehicle. We'll continue to closely monitor that and report back. And then also just making sure each fee is reasonable. And so you can see that on page 5. We've given you each investment option, their peer group, or other managers who are employing a similar style. We've given you the expense ratio of that fund, and then 2 different peer group benchmarking services. So Investment Metrics and also Morningstar. If you look at that third column, you can see again, each expense. The one thing I want to note here is where you see rev share. So for instance, with MFS mid cap value, the expense is 99 basis points, but 50 basis points of that is given back to participants in the form of revenue sharing. And we only give it back to those participants who are in the fund because that's the most equitable arrangement. So if you go down the list, you can see that we're all very competitive. The one note is with PIMCO Total Return, it says above average for Morningstar. However, Morningstar is not taking into account that 35 or 45 basis points that's being given back to participants. So at net 35, it would rank very competitive if that was taken into consideration. So
Why would they not take it into consideration for PIMCO and they do for the others?
Because not all investors in that share class get that revenue sharing. So it is because we're on the Nationwide platform that agreement gives us back 45 basis points. Most record keepers get probably the same amount. However, we have seen some differences among record keepers. So that's why it's so important for us to not only check with the investment managers, but we also check with Nationwide as to what are their revenue sharing agreements for each of the funds. And so we have kind of both checks to ensure that we're in the most appropriate vehicle and share class. Yeah. The other one that we've been monitoring is on page 6, the Fidelity Low Price Stock Fund. We are in that green row. So we are in the retail share class, 89 basis points with 25 basis points given back at a net cost of 64 basis points. You can see another share class K6 and also a collective investment trust that's available at 50 basis points. However, our retail share class has a performance-based fee component to it. So we see our share class expense fluctuate, and it fluctuates quite a bit each year. And you can see that on the right within that those 2 columns in the table on the very far right. So what we have done is taken a historical average of the expense ratios, and you can see our retail from a historical basis is just slightly less expensive. We don't want to chase share classes, so we'll continue to closely monitor it as we have done every year. But right now, we're recommending to stay where we are, but we'll continue to monitor this each year. So switching gears to go ahead.
Excuse me, I'm
Yeah.
just looking at that historical reference there you've got. It seems like the last 4 years have been higher and trending higher. I mean, is there any
It
particular explanation for that?
it corresponds back to their performance.
Okay, okay.
Yep. So when they outperform, you'll see a higher expense.
Okay,
Yeah.
okay. Gotcha, thank you.
Oh, no problem. And we went back to 2017, just given that was the inception of that K-6 year class to make them an even playing field too. I should have pointed that out as well. Okay, so switching gears to record keeping fees on slide 7. Again, our record keeping fees are transparent and clearly provided to participants on their statement. Our expense is $48 per participant with Nationwide. That was benchmarked and negotiated as part of our search process. I do note that, given where we are within that agreement, there will likely be some discussions behind the scenes to evaluate that fee a little bit more. But overall, it's reasonable relative to the search that we did back in 2021. And slide 8 totals our expenses for us. So an actual dollar value of what was paid for record keeping fees to Nationwide of that $48 per participant in 2024 was $3,032,000. And when you take that plus the average investment management expense estimated, you get a total fee of roughly 39 basis points per participant. And that is down from 42 basis points when we did this analysis 1 year ago. And then on slide 9, we have our managed account services fee. That's that discretionary service for participants who would like to utilize the pro account service that can take discretion and adjust their portfolio based on their unique circumstances. Nationwide collected $2.6 million for those services in 2024. We have the fee schedule over on the right, and it is comparable to peers based on our search and other clients that we have across our defined contribution clientele. And then on slide 10, we have our unallocated plan account, and this is utilized from the comptroller's office to pay for plan-related expenses. That is $6 per participant per year. And you can see the expenses at the top of what that, totaled across, personnel and consultants and legal for 2024. We collected $389,000 approximately in 2024, and primary expenses totaled roughly $208,000 in 2024. And then lastly, we have capital cities fees. Again, we always want to be transparent as well. We're evaluating investment management and record keeper. We want to detail our fees too. So that's $82,500 each year. That's the only fee that we collect from the plan. There's no kickbacks from investment managers or record keeper. And that's the case for all of our clients. So I'll pause there to see if there are any questions regarding the fees. Okay. In your back pocket is a memo to the State Board of Finance. And again, the fourth quarter report that we just gave you, along with this memo, would be delivered to the State Board of Finance, excluding the considerations and observations page. So that memo just highlights the changes again that happened in 2024. One being the self-directed brokerage account option was added effective January 1st. The administrative fee, what's paid to the unallocated plan account, was increased from $3 to $6 per participant effective January 1st of 2024. And then finally, those investment menu changes that I highlighted on the consideration and observations page back on November 8th. So the Vanguard FTSE, American Euro Pacific Growth, both being eliminated and changing that share class for Fidelity Diversified. So I'd like to pause there and see if we could take a vote to approve the report and memo for the State Board of Finance.
Yes, I'll move to approve that report to the Board of Finance.
I'll second. Okay. All those in favor say aye.
Aye.
Aye. Opposed, same sign. Motion carries.
Okay, great. Well, the last couple of items, let's start behind tab 3. And that is our investment policy statement. We have given you a marked version. I also have a clean copy here to pass around for signatures. But as you know, our investment policy statement is a very important document. It formally documents all those strategic planning decisions, lays that roadmap for how we monitor the program. It also is just a really great resource. It shows, the roles and responsibilities of all of the key players. And so what we have done here, and as you may recall from the last meeting, if you go to page 6 of this investment policy statement, we have the language that was amended under the committee's responsibilities. And I'll give you a minute to read it, but basically what it's just saying is that non-financial factors will be excluded from our evaluation as part of the design of the investment menu and also the ongoing monitoring of the investment menu.
Would you go ahead and read it for
Sure.
us?
The committee must objectively select and evaluate the plan's investment options based on financial factors. And then parens C, selection of investment managers and monitoring investment managers for further details. No weight will be given to non-financial factors that further social, political, or ideological interests when designing the plan's investment menu and conducting ongoing monitoring of the investment options offered outside of the self-directed brokerage account. A dedicated focus on fiduciary duty requires that divergent positions on matters of public policy are best resolved by officials who can be held accountable through the democratic process by their constituencies.
Thank you.
So that is the one amendment to the body of the document. And then if you move ahead, and it would be right past the signature page. So right past page 20 is our appendix section. And we purposely put housekeeping items within the appendix section. And by that, I mean things that we think will change throughout the year. We don't want to have to amend the body of the document, every quarter. So we did make updates to the appendix section. So as you go through it, you'll note some changes. Like, for instance, we updated the current assets across the 4 plans. On the next page, we also updated our historical record. I love this section. It's a really great resource. If you ever want to see what changes happened in the plans, when it happened, why did it happen, it's all outlined in this section. And then we also made some updates to the investment menu section. And that really is just to reflect, again, Vanguard FTSE Social Index and American Fund Zero Pacific Growth being eliminated. So those have been taken out of that Appendix B as well. And then we went ahead and just included the 2070 fund and renamed the retirement income fund to retirement, got rid of the 2020 fund, just given we know those changes are happening in March and April. We didn't want to already be out of compliance. So those updates have been made too. So I'll pause there to see if there are any questions and, and ask for a vote of approval to the amended investment policy statement.
Questions after review?
No?
I don't have any.
Okay.
I will move to accept the amended investment policy statement, including the appendix update.
And a
And I
second.
will second.
All those in favor say aye.
Aye.
Aye. Opposed, same sign. Motion
Great.
carries.
Thank you.
This is such great work here. All the record keeping that goes back in time.
Yeah.
Goodness to.
Yeah, it's whenever there's committee turnover, they'll
20
always have that
years.
reference as to what happened and when.
It's very helpful.
Yep,
All right, now I do have a question.
sure.
Did we need a vote on the performance evaluation report?
That is actually the State Street vote, so I'll get to, that's the next
Okay,
item.
that's the next.
Yep. We were originally going to ask for it in the report, but given yesterday's meeting. Okay, so our final item is the State Street Investor Voting Choice Program. And I apologize, I didn't make it in the book. So you should have a handout that looks like this that was laying beside. Mike, I think yours is right. Yeah, right
Yes.
there. And Here's a, if Elise, right there's a copy for that to Elise. So as you know, historically, the committee and the comptroller's office really hasn't had the ability to take an active role in the proxy voting process. And that's given that the vast majority of our assets are within commingled and mutual fund vehicles, meaning our assets are commingled with other investors. And so it's been the responsibility of our investment managers to vote our proxies for our investment options. However, as we have been doing our due diligence with State Street, and they've met with the committee a couple of times now, but at the last meeting, they talked about their investor voting choice program that they have for their equity funds. And as part of that, as plan sponsors, we can select our preference for how we would like, our proxy voting to occur. And since our last meeting, there have been 2 new policies that have been added. And given that we are fastly approaching the proxy voting season, what we'd like to do is to instruct State Street as to what our preference is for the proxy voting. Now, with all that being said, we are still working behind the scenes as follow-up to our Boyer discussion, so we'll continue those discussions. However, we do have some policies here that would be appropriate, that would reflect the preferences that we've heard from the committee in the past. And one in particular is number 9 on your slide here. And that's the Egan-Jones Wealth Focus Policy. And I'll just read it here. It's designed to maximize shareholder value. It does not prioritize environmental or social goals. And generally, they will vote against, for example, ESG related type of factors, even if the board is in favor of it. This most closely aligns based on our discussion with State Street, what we've heard for your preference and what we just discussed as part of the investment policy statement, that non-financial factors will be excluded from those considerations. So what we'd like to do is to take a vote to approve the number 9 Egan-Jones Wealth Focus Policy where possible with our State Street funds so that we can take a more active role in the proxy voting process. So I'll pause there. I know I said a lot, but happy to answer any questions.
I don't have any questions. I'll make a motion to approve that, number 9 be selected for the proxy voting policy.
I'll second.
All those in favor say aye. Oh, excuse me.
All those in favor say aye.
Aye.
Opposed, same sign. Thank you. Motion carries.
We've been on a good journey.
Yes, we have.
Of discovery. So thank you for going on it with us, seeking
Yeah.
to understand. And it is good for Indiana to be owning those proxy votes because they make a difference. And we want to make sure they make an impact according to fiduciary duty.
Yeah, absolutely. Yeah.
That
So-
concludes ours.
Thank you very much. Is there any old business, new business? All right. Again, welcome, Kim. We're so glad you're with us. Look forward to, you really have, you carry on with the great culture of Nationwide as far as customer service. So. Is there a motion to adjourn this meeting?
So moved.
In a second?
Second.
All those in favor say aye.
Aye.
Aye. The next meeting will be Thursday, May 15th. Thank you.